Hi everyone, my name is Dominic Brisson, and I'm a senior in Marquette's Applied Investment Management program. Today, I'll be pitching the Timken Company with a price target of $92.61 per share, representing upside of 34%. The Timken Company manufactures and distributes bearings and power transmission products. Timken operates through two segments: Mobile Industries, which is 47.6% of fiscal year 20 revenues, and Process Industries, which is 52.4%. The Mobile Industry segment develops products for OEMs serving customers in the agriculture, mining, construction, on and off highway, rail, and aerospace sectors. The Process Industries segment serves OEMs in capital-intensive industries such as general and heavy industrial, metals, and power generation. Timken also sells aftermarket products to individuals, equipment owners, and maintenance shops. Timken generated 52.9% of fiscal year 20 revenues in the Americas, 24.1% in Europe, Middle East, and Africa, 14.9% in China, and 8.1% in Asia Pacific, excluding China. Timken was founded in 1899 and is headquartered in North Canton, Ohio. The Timken Company was formed when founder Henry Timken sought to improve wagon efficiency with tapered bearing solutions. After success in that market, he positioned Timken to capitalize on bearings growth in the automotive industry by relocating to Ohio. Timken's growth flourished, and they supported the United States forces in World War II, delivering millions of bearings to Army Jeeps. Timken recently began repositioning their portfolio in 2009 through the divestiture of its needle roller bearings business to reduce the company's automotive OEM exposure and reduce further revenue and profitability cyclicality through the spin-off of their commodity steel business in 2014. Since that time, Timken has sought to increase focus on power transmission products and has made 12 acquisitions to expand margins and diversify sales since 2016. Timken maintains leading domestic market share of 20.1% in the United States ball bearing manufacturing industry, where they hold 5% greater share than their next closest competitor. Driven by accretive acquisitions and organic growth, Timken grew sales at a 7.1% CAGR over the past 4 years. As a result of the portfolio repositioning, Timken has decreased their risk profile, and with fiscal year 21's dividend increase, has now raised dividends for the past 8 consecutive years and positioned themselves to continue increasing it as earnings grow. In fiscal year 20, Timken's revenues declined 7.3% due to end market disruption from the pandemic. With the global economy rebounding from the pandemic, Timken is ready to capitalize on the bearings industry's robust outlook, as shown through Q2 2021 year-to-date revenue having grown 21%. Most recently, Timken has expanded into renewables. This area is a fast-growing component of end market sales, and last December, they committed $75 million in capital investment to position themselves to further benefit from renewables growth. Lastly, Timken has invested in their digital platform to capitalize on synergies from acquisitions and other revenue streams. Given Timken's positioning to benefit from the economic recovery, growth in renewables, coupled with the cost reduction benefits of their digital platform, it is recommended Timken be added to the AIMS Small Cap Equity Fund with a price target of $92.61 per share, representing 34% upside. In fiscal year 20, Timken's revenues declined 7.3% due to many industrial end markets suffering disruption from the COVID-19 pandemic. Timken recently announced their Q2 results and highlighted revenues rebounding across both segments. Management noted revenues through Q2 21 for the company were up year over year by 21% due to increasing demand across almost all end markets served. The global bearings industry is expected to grow at an 8.5% CAGR through 2028, and industry revenues are estimated to reach $226.8 billion by that time. Assuming the global recovery is not impacted by future economic slowdowns, Timken's top line is well positioned to benefit from this growth. Timken is an underappreciated renewables play, as wind and solar as a portion of end market sales have grown from 5% in fiscal year 18 to 12% in fiscal year 20. As a result of this growth and the positive outlook for renewables, last December, Timken announced they were committing $75 million in investments towards serving renewables. With the investment, Timken plans to consolidate and scale production capacity at sites to improve operations with advanced manufacturing techniques and automation. As Timken expands its renewable focus, this will benefit the profitability mix of the business, given renewable contracts carry above company average EBITDA margins, and further benefit profitability as process industries becomes a greater share of the sales mix. with the solar energy industry expected to grow at a 20.5% CAGR through 2026, and the wind energy industry estimated to grow at a 9.3% CAGR through 2027, TIMKEN will benefit from greater adoption of renewables. Having acquired 12 companies since 2016, integration is key to TIMKEN's strategy to capitalize on revenue and cost synergies. Over the years, TIMKEN has invested in their digital platform where all ERP and CRM functions are run. 70% of revenue streams currently operate on this platform, and 2 acquisitions, Equal Lubrication and Diamond Chain, as well as 2 more recent smaller bolt-on acquisitions, should be completely integrated through the end of the year. Once these companies are fully connected to TIMKEN's platform, it will help the company to realize revenue and cost synergies and improve their capacity to scale for future growth. TIMKEN views their platform as a competitive advantage since it enables them to quickly integrate acquisitions and improve business performance. To reach an intrinsic value for TIMKEN, a 5-year DCF model was constructed. Using a terminal growth rate of 1.5% and a WACC of 7.07%, an intrinsic value of $93.27 per share was reached. A sensitivity analysis was conducted with plus or minus 50 bips on the terminal growth rate and plus or minus 100 bips on the WACC, resulting in a range of $70.94 per share to $131.73 per share. A PE multiple valuation was also calculated using an average fiscal year 21 multiple of 17.1, which resulted in an intrinsic value of $89.40 per share. An EV/EBITDA relative valuation was also calculated utilizing a fiscal year 21 multiple of 10.6, resulting in an intrinsic value of $92.72 per share. By weighing the 3 models, 70, 15, 15, a price target of $92.61 per share was reached, representing potential upside of 34%. Through the first 6 months of fiscal year 21, TIMKEN's management noted they dealt with supply chain challenges and experienced increased freight costs as well. If these issues persist into the latter half of the year and beyond, this will negatively impact profitability. TIMKEN's products require raw materials and use metals, especially steel. Given recent price fluctuations in the price of steel and volatility with prices of other raw materials, if TIMKEN fails to manage the price fluctuations adequately, this could negatively affect margins. And lastly, $330 million of TIMKEN's debt is tied to a variable rate term loan that was used to fund their Rollon and Cone Drive acquisitions in 2018. Over the last 18 months, TIMKEN has benefited from low rates, helping to keep this loan's interest payments down. If interest rates were to rise in the future, this would lead to higher interest payments, negatively impacting earnings per share. Richard Kyle has served as CEO of TIMKEN since 2014 and previously served as the Chief Operating Officer of TIMKEN's Bearings and Power Transmissions Group. Before joining TIMKEN, Mr. Kyle held management positions at Cooper Industries and Hubbell Incorporated. Phil Fracassa has been TIMKEN's CFO since 2014, and he previously held corporate accounting roles with General Motors and Visteon Corp, and he is a CPA. Since 2009, TIMKEN has successfully acted to reduce their exposure to revenue and profitability cyclicality through a combination of spin-offs with TIMKEN Steel, divestitures to the needle roller bearings business, and acquisitions, of which they've made 12 since fiscal year 16. Through the portfolio repositioning, TIMKEN has successfully positioned their business for sustainable profitability through various economic cycles, as is evidenced by their EBIT margins only dropping 80 bips during the COVID-19 pandemic in fiscal year 20. Looking ahead, TIMKEN is ready to capitalize on the global economic rebound as many of their end markets activity increases, and they have a greater focus on renewables abroad, which should benefit the business in years to come. I want to thank everyone for listening to my presentation today, and I look forward to answering your questions during the Q&A this Friday.